Hello everyone, my name's David Robinson. I'm a tax director at Shorts and I'm going to talk to you about preparing to sell your business with a focus on the tax aspects. As a business owner, one of the best things you can do to withdraw funds from the business is effectively to sell an exit. It can be very, very tax efficient compared to perhaps taking a dividend or a salary. And that's what I want to try and get across today, with also just going through a few bits around what to do before the sale, ensuring that you maximize reliefs, and then to cover how the consideration is taxed, and then just to go through exit options in respect of tax and how they work. So first up, if you are looking to sell and sell your business, what we always advocate as a tax advisor is to get your house in order. What we mean by that really is try and prepare your business for sale. So that does two things. One, it maximizes value for you on an exit, but also it can minimize the risk of a price chip or a deal falling over. For example, if a buyer finds something that it doesn't like in your business. So what do we do in terms of getting your house in order before the sale? Well, one of the things we can do is try and remove assets that you want to keep. So that might be property that's in the business that you want to keep personally, or a car, or some plant and machinery or something like that. But it can also be perhaps, as a quirk of history, you've got two different trades in your business. So we can do something called a demerger. We can separate out the non-core trade from the core trade, which would be sold, and then that will nice and neatly package up your business for sale. If we do those two things far enough in advance of a sale, then we can generally extract assets or demerge a non-core activity in a tax efficient manner. So the more time you give us, the better, really. Secondly, on there, we've got incentivizing key staff. So if you've got some key members of your team that you really want to encourage and incentivize to grow the business, perhaps giving them something like a tax efficient EMI scheme or some tax efficient rewards and incentives can really help them to encourage them to grow the business, which will ultimately give you more value when you exit. So it's always always worth looking at ways in which you can incentivize those key staff to grow your business. The third bullet point on there is make sure that you claim reliefs where available. There's lots of different reliefs that are available for businesses. Particular companies can claim something called R&D relief. So if you're doing something innovative, which I'm sure a lot of you guys are, then make sure you've checked out R&D reliefs and make sure you've maximized those claims, because the more claims you make, the more cash you've got in your business, the more valuable your business will be when you come to exit. Similar for capital allowances, which is the way that you get tax relief on capital expenditure. So for example, if you spent money on your property, or if you spent money on plant and machinery, you can claim those allowances, which reduces your tax bill and ultimately increases value on exit. Lastly, on this slide, just got final bullet point, which is all about leaving cash in the business prior to a sale. As I said at the start of the session, if you leave cash in your business rather than drawing it out as salary or dividends, that can be a really tax efficient way of ultimately getting value from your business, which we'll see on the next slide. Moving on then, so when you actually come to think about selling your business, you want to make sure that you, as a shareholder or as a business owner, will maximize the value that you get from sale and therefore minimize the amount of tax that you're paying on exit. So as a shareholder of a company, which most businesses perhaps might take the form of, when you come to sell your shares, generally you're taxed at 20% capital gains tax, which is the rate at the moment. However, there is a reduced rate of 10% if you qualify for something called business asset disposal relief. This used to be called entrepreneurs relief, which you may be more familiar with. So that's a reduced 10% capital gains tax rate that you can have on up to £1 million of lifetime gains currently. To qualify, you need to have at least 5% of the business, and you need to be an employee or director, and you need to have that for at least 2 years. So general conditions that need to be met. And one of the planning things that we look at regularly is to try and share ownership around family or friends or other business partners, to make sure that you have lots of different £1 million lifetime allowances to maximise that relief. The final 3 bullet points on there, something that's slightly less known, is something called a substantial shareholding exemption. And it's worth thinking about if you are going to reinvest your proceeds post-sale. So for example, if you have a holding company and a subsidiary, if you were to sell that subsidiary company, providing certain conditions are met, effectively that sale can be completely tax-free for the holding company, which can allow that holding company to then go and reinvest the proceeds into the new venture. Moving on to how consideration is taxed. This is thinking about you as a personal shareholder selling your business. I'm not going to go through all of this slide, but I just wanted to kind of highlight that there are different types of consideration that you can receive on the exit of your business. That could be cash up front, could be loan notes, could be an earn-out. They're all taxed slightly differently. And I think the key message there is that if you are thinking about selling your business and you get offers for the business, it's important to take up tax advice, because one offer might be cash, one offer might be an earn-out with cash, and they're taxed slightly differently. So you want to try and compare apples with apples. Finally, from me, just wanted to touch on a few different ways that you could exit your business, looking at shares in particular, and just looking at the kind of tax aspects in general. So most business owners have come across a trade sale or a management buyout. The first one is where you sell effectively to a third party. With a management buyout, obviously selling to your management team. Thirdly, on there is a transaction called a company purchase of own shares, which effectively allows a shareholder to sell shares back to the company as a way of exiting. Now, that isn't generally kind of recommended or possible for majority shareholders. But if you've got a minority shareholder that's exiting in full, then that can be a good way of allowing them to leave in an efficient manner. Finally, on here, I've got a family buyout and an EOT. Just quickly on a family buyout. So if you've got a business that's family owned and the owner wants to pass on to the next generation, that doesn't have to be a gift. That could be a sale of shares, perhaps with some bank finance. And what that does is allow you to de-risk your investment and take some money off the table, whilst also passing on the business to the next generation. That can be a real good tax efficient way to allow the family to have some money out. Lastly on here, becoming increasingly popular, employee ownership trust exits. There's enough content there for a seminar on their own, but effectively, if you value succession and legacy and want to pass the business on to your employees, you can sell the business to an employee ownership trust, which is set up for the benefit of all the employees, so they participate in the kind of underlying value of the business forever. Key benefit for a seller is that as long as conditions are met, then your sale to an EOT can completely be free of tax, so completely tax-free, which is a very, very powerful and efficient way of selling your business and passing it on. So that was just a whistle-stop tour of some of the tax aspects to think about when looking to sell your business. I think from me, as a summary, it's important to just get some tax advice when you're thinking about it, and also when you actually get to the exit. Thank you.